Hi, everyone, and welcome to the Zero to Empire podcast. On this episode, I have Steve Selengut, and he's actually going to be talking about his financial background as well as him writing a book and everything that goes with that. So, Steve, what actually inspired you to write your book, Retirement Money Secrets?
I think a lot of it was getting to be an advanced age, and really wanted to spell out what I've been doing with my life and how many, how I have helped people over the years secure their in, in, income independence, and have a retirement where they could spend whatever they liked because they knew the money was coming in. They didn't have to give up any securities, didn't have to sell things to do what they wanted to do. And just to, pass that on as best I could. Uh, that was, I think that was really what really booted me forward on that. And I got a lot of support in that from members of my Facebook group at the time who were also saying, hey, yeah, we ought to put all this stuff we're talking about in writing somehow and get it out there. So that was part A, and that was probably the larger part. And part B was the fact that my old book, um, "The Brainwashing of the American Investors," which I thought had a lot of valuable information in it. It was more of a textbook type thing, but it was primarily focused on investing in the stock market in individual securities, which is how I spent pretty much the first half of my career was primarily in dividend stocks. And there are a lot of rules and requirements that I constructed at that time that don't apply at all to the closed end fund environment where I am now. So people be looking at the wrong numbers to make investment decisions, you know. Um, so I think I wanted to fix that. So between those two incentives, we got together and we produced the book. So I think that's what did it.
That's solid. And what actually got you into the whole investment world?
Well, now we got to go back a long time. The I started. I was putting a money away with my dad when I was a kid. When I was working odd jobs in summers, and when school was out, you'd mow lawns or you'd shovel snow or you'd do something, right? So he had a business of his own and had multiple, was a real estate developer and builder and renter and lender and insurer and so on. So he had a lot of multiple streams of income coming in, and he was interested in his children learning about making money and developing a flow, cash flow. He wasn't a stock market guy himself, but his attorney was. So what he did, he turned my brothers and my earnings in the summers, a certain percent of it he took, and he gave it to this other guy to invest for him. Well, that and not going to an Ivy League school like my brother did created a whole pot of money that was dumped on me when I was 25 years old. And I did have a business background. I was working for an insurance company in New York. I was getting educated there a little bit, um, but I mainly got educated with these stocks that I all of a sudden owned with a broker at the time, and she and I went through them all, and they were all dividend stocks, I think I said, and all well-known companies that you knew were going to be there. They weren't going anywhere. They weren't fly by night. Uh, the Nasdaq tech sector didn't exist at that time in 1970. A high tech stock would have been called IBM or GE. Okay, there was no AI. There weren't even computers for home use at that time, really. So in that environment, the world I had, the investment world I had, was a bunch of very safe companies, a lot of them, all that were sending me money on a quarterly basis. And I also managed to get myself some fixed income stuff. But we started looking at these things and we saw the volatility, even in those days when there was never $1 million or million share day back in the 70s ever, you know. Um, but, we'd look at all the volatility. There was still volatility. Stocks did go up and down. Okay. But what we determined was that their range, it was an upward trend, but the range between up and down was pretty stable. And we determined that anytime any of these wonderful companies, and there were about 200 dividend payers that we were looking at, would fall 10% or 20% or more from their 52-week high, we'd start buying them. And then as soon as they went up 10%, we'd sell them. And we do the same thing with the same stocks over and over again. So that's where I got my start, and that evolved into my frustration with working in Manhattan and commuting from North Jersey uh, for an hour a day, sometimes 2 or 3 hours at night, depending on weather and all the other stuff. And saying, I'm making 4 or 5 times my salary on the dividends and the profits I'm taking on these stocks. I'm paying for our vacations with my investment program. You know, I don't need to commute anymore. My wife also had a job. She was doing fine. So I said, I'm gonna throw in a towel here. I'm gonna get out of there. I had just enough to vest for the pension when I'm 65. I was going to get a check. Big deal. I get 200 and something dollars. I love it. And I'm going to start my own business, Sandy. I'm going to start doing what I'm doing for our friends, for people we know. And that's how it all started. I was doing it, and I started doing it for other people. And it grew. It didn't grow fast. Because it was all word of mouth, and I had to build a track record. You can't go to somebody just with an idea. You got to show them some statistics, and I wanted to show them statistics not just of my own, but of other people's as well, that I have been doing it, and that's how it got started. By 2020s, around there, we broke above 190 million, and then in 21 at the end of 21 we had over 110 million under management, maybe 155 clients around the country, some overseas. Average size of relationship around 600 grand. You know, so it got to be it was a nice business. And then this company made us an offer we couldn't refuse, basically. So.
That's solid. Very happy to hear that. And so before this, we talked about how you like to be focusing on closed-ended funds. And so can you talk a little bit about that and like why most people don't really know anything about that?
Closed end. I actually discovered two closed end funds way back, late 80s. That time, both were um, both were equity funds. And the thing I found attractive about them was they both paid huge dividends at the end of the year. They'd be going along and maybe averaging maybe 1.5%, 2% the first 3 quarters of the year, but their December dividend was always multiples of that. The one was in the energy sector, and the energy sector, when my career was developing, the energy sector was the most exciting of any. There were raiders all over. There were combinations of companies. There were new pipelines going in. There was the cartel over in Saudi Arabia, and all these things were going on, and the price of oil was starting to move up and everything. And it was really such easy pickings. Talk about Boone Pickens, one of the guys that was chasing all these companies. It was easy pickings to make money in the energy sector. And this one company, one security, it was called Petroleum and Resources at the time, was the one that paid this super huge dividend at the end of each year. So I would buy it in September. The dividend would be declared, let's say, late November, something like that. price would go up. It might have gone up like 7, 8 times, 10 points sometimes, 10% sometimes. I'd sell it, get rid of it, pocket the money, and then in the next September I'd do it again. And ADX was in the same boat. I didn't really know they were closed-end funds. Then around in the early 90s, maybe 1990 itself, I got a new client who had a couple really high income securities in the portfolio, and I looked at them and I discovered that they were closed-end funds, and then I discovered what closed-end funds are all about, and then I discovered that instead of going through all the amazing bureaucracy and problems to buy and sell bonds that we had in those days, I could all of a sudden say, "Hey, Ken, buy this. It's a closed-end fund. It owns 387 different bonds. We're going to buy it, and when it goes up 5%, we're going to sell it." Oh, okay. We don't have to do this, this, and this anymore. So that was a discovery. That was like a eureka moment, like almost none other. And I had my portfolios, the income part. This was when we were younger, so there wasn't as much income invested as equity at that time. But the income side was, $30 million in Ginnie Mae's corporate. They called them corporate unit trusts and preferred stocks, and I had individual municipal bonds as well. And I just got rid of them all profitably as soon as I could and switched to these closed-end funds. Just changed. Everybody was making more money. I actually got fired. Closed-end funds, when you see them on your statement, they're listed. You got that little round thing that says how much you have in stock market equities. Well, closed-end funds trade like equities, though, so they're reported on your brokerage account statement as equities. So I had this one bond investor out in Long Island, and I was mostly municipal bonds with him. And after I got done converting, he looked at his portfolio and said, "What have you done? You've put me in the stock market." And I said, No, I haven't. Take a look at what's inside. Those are municipal bond closed-end funds. You have more municipals than you ever could possibly own independently. He said, "Oh my God, you're in the stock market." He didn't understand at all. And he fired me because he thought I'd put him in the stock market and I'd put him in bonds and in yields twice what he was making earlier. He just couldn't see it. And there are still many people today that can't see it either. So that's the story. I discovered them, and then it shifted my whole approach. I was still doing mostly stocks because they were still fluctuating. The good quality companies were still fluctuating to 20%, and I could take to 10% and so on. I was making a lot of money doing that. But then after the financial crisis, interest rates went to zero. Stocks went up for 12 consecutive years, pretty much. And all of a sudden, the only things that were down 20% from the 52-week highs were things you didn't want to buy because they were really in trouble. So that's when I made the switch. I said, okay, I've sold all my stocks. I've taken all my profits. All the money's going into these closed-end equity funds, and that's what I've done from that point since. And if I had done it as I could have back in the early 80s, we probably wouldn't be speaking today. I'd probably be on my yacht in the Mediterranean, something like that. So.
Oh yeah, 100%. That'd be really sweet. And so a lot of people tend to actually panic during the market downturns, and you've been through dot-com bubble, 2008, and COVID. So how do you actually teach your clients to stay disciplined?
I've also been through 9/11 and the crash of '87.
Oh yes, correct.
I'm just kidding. It's when all those things are happening, when you have a portfolio of securities that you trust, like the companies we talked about, the oil companies, the big health companies, the service company, all these big name companies that are household words. You drive down the street, you see Walmart, you see this. You used to see Sears, not anymore, but so when you can trust them, when you know they're paying you dividends. That's what you have inside closed-end funds, and they're all paying you these dividends. You just they're not going away. You've been to in '87, none of the big companies cut their dividends, barely at all, even though that was such a crisis at the time. I think it was really just a computer loop, but still, it was exciting. But we were, when you have that kind of quality, that they're diversified, they're quality, and you have that, they're that good of a company, instead of panicking, you're rubbing your hands together. I said, I'm going to get this much money at the end of the month. I'm going to be able to buy these things again at prices 20 and 30% below where they were a month ago. And I'm doing the same thing right now. The market right now is about where it was last July. I just can't, I'm taking any profits I can, however small they are, because I take that capital and I reinvest it at prices that are, 10% below what they were just 6, 7 months ago. I mean, this is a buying opportunity. If you look back and look at the charts, look at the numbers, there has never been a correction that hasn't been replaced by a new rally. Of course, vice versa too. You also have to realize that when the market's up, it's a lot more dangerous than when it's down. But I've never lost any sleep over a down market. I worry more when we're hitting all-time highs every other day. That concerns me more, because then I sort of know in the back of my mind this isn't going to last forever. So.
Oh yeah, that's some very important advice right there. Can't be catching on that FOMO when it's at the top. And when it comes back to the closed-ended funds, how do they tend to usually yield a higher return than traditional investments?
They yield higher for two reasons. The first reason is, think about, they're required to pay 95%. They're trusts, first of all, trust vehicles, unlike any other, and they're required to pay 95% of their earnings to their shareholders. Okay, so they're not going to grow a whole lot in market value if they have to give away that much of their earnings. What are they going to use to invest in? To invest more in, right? Just a little bit of money. Think about Amazon. If Amazon had to pay out 95% of its earnings, instead of right now, how much is it paying?
Yeah, nothing.
Okay. If it had to pay 95%, would it have taken off and grown like it has? Of course not. So that's the distinction. Nobody's heard of them. Nobody pays attention to them because they're just not sexy enough to get their attention. These things are built for income production, not for growth and market value. It's a different mindset when you go into them. I've got Amazon probably in 75, 80% of the closed-end equity funds that I invest in. I've got Microsoft in there too. I've got Nvidia. I've got Tesla. I've got this, that, all the big stars are in there, but that's what they're just not built for going up in market value because they're paying out all their earnings. So how do they pay? Right now they're paying over 10%. Income ones are paying over 10%. Equity ones are paying over 10%, and tax exempt ones are paying around 7%. These are literally the highest rates I've ever experienced in my history of dealing with closed-end funds. But here's how they get more money, and it's the same way that those big companies we just talked about grow their business. Okay, they borrow money from banks. They borrow money from us by selling us bonds, loans, notes, stuff like that, and they reinvest it, knowing that having another McDonald's on the corner is going to make them more money than the interest is that they're paying on that loan. So closed-end funds are doing exactly the same thing. They're borrowing and they can borrow up to 50% of their net asset value. Most of them borrow in the 30% range, and they don't borrow a lot when interest rates are up. I mean, these are managed portfolios. There's a guy like you and me making the investment decisions, and we're saying to ourselves, okay, I can borrow money. 5 years ago, I can borrow money at 2%. I could just go and buy a bunch of closed-end funds that are yielding 8%. That would be neat. And I can give all that difference, the 2% I'm paying out versus the 8%, I can give that to my shareholders, And that's exactly what we're talking about. That's how they pay so much more, because they use the same, they call it leverage. They call it borrowing when a corporation does it. Wall Street calls it borrowing when Exxon does it, or when, you know, um, uh, you know, uh, any other companies do it. But when a closed-end fund does it, because they don't want you to know about them, they call it leverage, because that sounds like a bad thing. And you and I use that. I bought my house with leverage. Did you? I borrowed money from a bank. I bought my car with leverage. I borrowed money from the bank. So leverage is not a dirty word at all. Leverage is what everybody does. Every American does it for sure. Most people all over the world do it in order to get the lifestyle they want. They borrow money. So that's how why they are unknown, because they're not sexy. And how do they produce so much income? Because they're structured to pay out 95% of what they do earn, and they use leverage to increase those earnings for you. It's all short term. It's not variable rate, and they turn it over quickly. There's only been once in my history that a closed-end fund has not paid a monthly distribution because its leverage got too high. 50% is the maximum. And that time was during COVID, because the market dropped so quickly in a 2-month period that the market value went down enough that the leverage amount, which probably was around 30, became 50, because, it hadn't been repaid yet. So a month later, we got the dividend anyway. So it didn't matter in the long run. But it's how capitalism works, is with leverage.
Oh, yes, 100%. And when it comes to investing today, imagine if you had not that much, or even zero, what would be your first few moves?
Well, well, sorry. How you start your investment program will vary. When you just get started, it's a good time to reduce the amount of risk you have by having some form of a fund. And if you're going to use a fund, I use closed-end funds because they pay higher yields typically than mutual funds do. And generally speaking, 90% of ETFs, closed-end funds, pay a whole lot more than that. And since they contain many, many different securities, they don't have the risk. Like if you started with $1,000, did you know that IRAs, when I started my IRA, the maximum you could put in a year was $1,500?
Wow.
So let's say at that time you took that $1,500, you could have bought a closed-end fund that contained pretty much every stock in the stock market, But if you had $15 to spend, you wouldn't, $1,500, you might have been able to buy 100 shares of one or two different stocks, not many, a year. So instead, you could have bought the closed-end fund yielding 7 or 8% at that time, 6, 7, or 8%, or you could have bought two stocks and hoped that they didn't go bust. So it's a much safer way to start when you're small. And if I were starting, like when I started my grandkids' accounts, I started them with a bunch of closed-end funds. I gave them X amount of dollars, and I bought closed-end funds with them.
Solid. That's really cool.
So yeah, it's a safer way to get started. And if let's say you're starting with your inheritance, or you're starting with your year-end bonus, because you're in your 30s and you're working for a good company, you got a big job, and you get, like my daughter did, a 6-figure bonus, and it's your first one. And instead of saying, well, I'm gonna go to Europe, or I'm gonna buy a new car, you just say, well, I'll do that with half the money. The other money I want to get invested. You know, you start off with a portfolio of closed-end funds, and it would be generating income, for all these years. You'd have so long at 10%, which is what they're paying right now, and that's without taking any profits along the way. Your money will double in 7.5 years, compounding. So,
Yeah, that's solid. And where can actually people reach out to you to find your book or get your help?
well, um, my business as a coach is theincomecoach.net, and they can also get. There's certainly links to the book there, but the book is at Amazon like all others, and it's in all forms. It's audiobook, ebook, paperback, and hardcover. So it's all there at Amazon.
Solid. Make sure to go get his book. It'd be a great read, if not more. And for everyone watching in or listening in, thank you for being on this episode of Zero to Empire, and I'll see you on the next one.